If you make $109,000 this year, the government is about to take an extra $2,100 from you, not in taxes, in Medicare premiums, and it gets worse. At $142,000, they'll take $4,800. Most financial advisors won't tell you this until it's too late. Now you might be thinking, I don't make that much. But here's the thing. If you sell a house, cash out in IRA, or take a larger withdrawal, you could trigger this surcharge without even realizing it. One decision, 1 year, and suddenly you're paying 40% more for Medicare. I'm going to show you the 5 income tripwires that destroy retirement budgets, illegal loopholes the wealthy use to avoid them, and why your CPA probably hasn't warned you yet. Quick note, this is educational content only, not financial advice. I'm just a guy with a spreadsheet and a lot of questions about why the system punishes savers. IRMAA. A stands for Income-Related Monthly Adjustment Amount. Fancy name for a simple concept. If you made too much money 2 years ago, you pay more for Medicare today. Let me repeat that. Premiums you pay in 2026 are based on your 2024 tax return. So if you had a one-time spike in income, you're about to get punished for it. Sold a rental property? Punished. Took a big IRA distribution? Punished. Cashed in stock options? Punished 2 years later. But here's the kicker. These aren't small increases. We're talking about 5 income cliffs. They can cost you an extra $2,000 to $6,000 per person per year. And if you're married, double it. Now here's what they don't tell you. This is a stealth tax on the middle class. You worked your whole life, saved responsibly, built a nest egg, and now they're taking more from you when you can afford it least. Let's talk about the 5 income tripwires. These aren't theoretical. I'm going to show you exactly how ordinary retirement decisions turn into premium nightmares. Tripwire number 1. You cross $109,000 as a single filer. Maybe you sold your paid-off car and replaced it. Maybe you helped a grandkid with college. Boom, $81 extra every month. That's $972 per year. For married couples, the threshold is $218,000. Tripwire number 2. You hit $137,000. That Roth conversion your advisor recommended? It just cost you $203 per month. Over $2,400 per year in Medicare premiums. Tripwire number 3. You cross $171,000. Now, you're paying an extra $325 per month. Almost $4,000 per year. Tripwire number 4. You hit $205,000. Maybe you sold a rental property after owning it for 20 years. Congratulations. Your Medicare premium just jumped $446 per month. That's over $5,300 per year. Tripwire number 5. You go above $500,000 as a single filer. At this level, you're paying an extra $487 per month, nearly $6,000 per year. And for Part D prescription coverage, add another $91 per month. But wait, it gets worse. The IRS knows exactly what they're doing. These brackets aren't all indexed for inflation. The top bracket, frozen until 2028. So every year, more retirees fall into these traps, simply because their cost of living went up. Now here's the thing. Let me show you how the 1% play a completely different game. When Warren Buffett talks about paying less tax than his secretary, this is part of it. Wealthy retirees structure their income differently. Municipal bonds, Roth accounts, qualified charitable distributions. Their accountants plan 5 years ahead. They keep their modified adjusted gross income below the cliffs. Meanwhile, you worked hard. The person who saved responsibly, paid off Your house built a nest egg. You get whacked because you took a $50,000 IRA distribution to replace your roof. Here's the part that should make you angry. The system is designed to catch middle-class retirees at their most vulnerable moments. Selling a home after a spouse dies? IRMAA surcharge. Cashing out a 401k after job loss? IRMAA, a surcharge. Penalties hit hardest when you can afford them least. Now, here's the kicker. High net worth individuals have teams of advisors planning around this. Your CPA probably didn't even mention it. Not until the bills showed up. It's not your fault. It's by design. They want you confused. They want you paying. Okay, enough doom. Let's talk about what you can actually do about this. Strategy number 1. The 2-year smoothing plan. Remember, IRMAA looks at your income from 2 years ago. So if you know you'll need to take a large distribution, split it. Split it across multiple years. Instead of taking $150,000 in 1 year, take $75,000 over 2 years. Same money. Half the IRMAA penalty. Strategy number 2. Qualified charitable distributions. If you're over 70 and a half and you donate to charity anyway, do it directly from your IRA. It satisfies your required minimum distribution, but it doesn't count as income for IRMAA purposes. Wealthy have been doing this for decades. Strategy number 3. The life-changing event appeal. Did you retire in 2024 or 2025? Get divorced? Lose a spouse? You can file Form SSA 44 to appeal your IRMAA surcharge. The Social Security Administration will recalculate your premiums based on your new income level, but you have to file it. They won't do it for you. Strategy number 4. Roth conversion timing. If you're going to convert traditional IRA money to a Roth, do it in low-income years, right after you retire, before you start Social Security. That way the conversion income doesn't push you into an IRMAA bracket. Not when you're already on Medicare. Strategy number 5. Capital gains harvesting in 0% bracket years. If your income is low enough, you can sell appreciated stocks and pay ZERO capital gains tax. But if you wait until you're on Medicare and trigger IRMAA, you just turned a tax-free move into a $3,000 surcharge. But here's the thing. Most CPAs don't proactively plan for this. You have to ASK. You have to demand that. Your financial team looks at your 2-year income projection, not just this year's taxes. Now, there's one more strategy almost nobody talks about. Tax loss harvesting to offset gains. If you're going to have a big income spike, look for losing positions in your portfolio. Sell them, offset the gains, stay below the IRMAA cliff. It's legal. It's smart. And the wealthy do it every single year. Here's why this matters right now. If you had a high-income year in 2024, your 2026 Medicare premiums are already baked in. Sold a house? Took a big withdrawal? Whatever. But you have until April to file an appeal. If you had a life-changing event, marriage, divorce, death of a spouse, retirement, these all qualify. And if you're planning any big financial moves in 2026, you need to think about your 2028 premiums today. This is a 2-year chess game, and most people are playing checkers. Let me put it in real numbers. If you're 65 today and you pay an extra $3,000 per year in IRMAA penalties for the next 20 years, that's $60,000. Money that could have gone to your grandkids, to travel, to charity. Instead, it goes to subsidize a broken system. Now, here's what I need you to understand. This isn't about cheating. Every strategy I've shown you is 100% legal. The question is, are you going to keep playing by the rules they set for you? Or are you going to play by the rules the wealthy use? But here's the final thing you need to know. The people who get destroyed by IRMAA are the people who don't plan. The people who trust the system to be fair. The people who assume their advisor is looking out for them. Don't be that person. So here's what you do next. Step 1. Pull out your 2024 tax return. Look at line 11, your adjusted gross income. Compare it to those 5 cliffs I showed. If you're within $10,000 of a tripwire, you need to plan your 2026 income very carefully. Step 2. If you had a life-changing event in 2024 or 2025, file Form SSA 44 immediately. Retirement, divorce, loss of income. Don't wait. The appeal window closes fast. Step 3. Talk to your CPA or financial advisor. And I mean talk. Don't just hand them documents. Ask them explicitly, what is my 2-year income projection for IRMAA purposes? If they look confused, find someone who isn't. I've put together a free IRMAA appeal checklist. Link is in the description. It walks you through the SSA 44 form and the qualifying life events. And if you want me to break down Roth conversions in future videos, let me know. Qualified charitable distributions. Tax loss harvesting. Let me know in the comments. This channel exists because the financial industry doesn't want to have these conversations with you. Remember, they designed this system to be confusing. Our job is to make it simple. Subscribe if you want more of this. And share this with anyone you know who's approaching Medicare age. They'll thank you in 2 years, when they're not writing a surprise $5,000 check to the government. Stay skeptical. Stay informed. I'll see you in the next one.